So right now, there is this massive traffic jam of oil tankers just sitting idle right outside the Strait of Hormuz.
Right, and for the last 4 months, that specific maritime choke point has been practically frozen by the conflict.
Yeah, which has been injecting this low-level hum of anxiety and a literal price markup into basically every global transaction.
Exactly. But today, the captains of all those ships and global markets along with them really just took a massive collective exhale because the U.S. and Iran have finally agreed to a framework deal to end the war.
Wait, really? So Brent crude must be dropping, right? I saw it plummeted over 5% to, what, around $82 a barrel?
Yeah, right around 82. And stock markets across Asia and the U.S. are surging because we are watching the real-time deflation of the geopolitical risk premium.
Okay, explain that premium a bit. I mean, I look at the Strait of Hormuz like a clogged global artery.
Well, that premium is essentially the invisible tax baked into everything from logistics to manufacturing whenever the threat of a closed Strait of Hormuz exists.
Because roughly 20% of the world's oil and liquefied natural gas usually passes through that specific corridor.
Right. So the market is aggressively pricing in the return of normalcy right now,
Mm.
instantly reallocating billions of dollars based on this memorandum of understanding. The signed framework includes a pause in hostilities and a pledge to remove naval blockades.
But wait, market pricing and physical reality are two very different things. The signed framework is great, sure, but physically clearing naval mines from that waterway could take months.
It could take anywhere from a month to 6 months, actually, according to retired naval commanders. There is a staggering backlog of tankers waiting to move.
So the market's blood pressure is down, but the physical blockage is technically still there. Our mission today is to trace how this geopolitical relief ripples directly into your wallet.
And following that ripple effect means looking at the mechanics of money from the gas pump all the way up to the Federal Reserve.
Plus, we are going to explore how the very concept of a price tag is mutating right now, from the stadium economics of this week's World Cup to the bespoke financial engineering funding the AI boom.
Well, starting with that energy shock, you have to look at how it actively altered consumer behavior. Over the last quarter, Costco reported record-breaking gas sales.
Oh, wow. So drivers were bypassing the convenience of your local corner station to wait like 20 minutes in line at Costco just to save a few dollars?
Exactly. All 3 4-week periods of their last quarter set successive all-time volume records. It shows how profoundly sensitive household budgets are to that geopolitical risk premium.
Think about your own monthly budget. When you're paying a premium at the pump, that acts as a regressive tax, meaning less money to spend elsewhere.
And now that crude is dropping, the relief extends to some pretty unexpected places. Market data indicates a sudden boost for credit card issuers like Capital One.
Oh, I see the connection there. Lower gas costs give everyday consumers a slight bump in discretionary income, which mathematically lowers the probability that they default on their credit cards.
Right, and that consumer relief actually provides crucial political and economic cover for Kevin Warsh. He takes the podium this Wednesday for his first press conference as chair of the Federal Reserve.
And throughout the spring, inflation metrics were looking incredibly stubborn, largely driven by those elevated energy prices, right?
Exactly. So with oil tumbling, Warsh can now hold interest rates steady this week without looking like he's just ignoring inflation.
Plus, he steps into this role possessing some unique political capital. He has the explicit trust of the president, which is a massive advantage for a Fed chair.
It's huge. That alliance gives him the institutional runway to pursue a highly controversial agenda, which is altering how the Fed actually measures inflation.
He wants to move the central bank away from its traditional reliance on the core PCE metric. But let's unpack that central bank jargon for a second. What exactly is core PCE?
So PCE stands for personal consumption expenditures. The core part is vital because it measures the prices paid by consumers for goods and services, but it intentionally strips out food and energy prices.
Because food and energy are historically volatile. Stripping them out gives the Fed a more stable guiding star to gauge true underlying inflation.
Right, but Warsh's argument is that artificial intelligence and new productivity gains are fundamentally altering the economy in ways that traditional backwards-looking metrics like core PCE just fail to capture.
So he believes the old math actually overstates inflation. And because he has the Oval Office's blessing, he feels he can navigate the internal FOMC debates, where he openly prefers a noisier, robust debate.
Yes, which is a big departure from the heavily managed consensus we saw under his predecessor.
But I have to challenge the idea that any Fed chair operates with a blank check. The real power broker, the eighth governor in the room, so to speak, is the bond market.
That's a very fair point. The bond market vigilantes will step in if they feel the central bank is being irresponsible.
Right. If Warsh starts tweaking the foundational math of inflation to justify keeping rates low, the institutional investors who buy U.S. government debt are going to notice.
And they punish central banks by selling off government bonds. When bond prices drop, their yields, or interest rates, go up.
Which means if they don't trust Warsh's new yardstick, they demand higher yields to compensate for the risk that inflation is secretly running hot. The mechanic is brutal and immediate.
Exactly. Borrowing costs for everything from your next mortgage to a corporate auto loan will skyrocket across the entire economy, effectively overriding Warsh's control.
So he really has to balance macroeconomic theory with actual retail reality.
Yeah.
He'll probably utilize this current drop in oil prices to buy time, pointing to cheaper energy as a reason to project stability this week.
That buys him the necessary months to slowly socialize his new inflation concepts with the markets before officially implementing anything.
But on a similar note, if bond traders might eventually punish the Fed, consumers are already punishing retailers in real time. The retail sector is painting a really vivid picture of a fractured consumer base.
We're looking at the stark reality of a K-shaped economy. The top line of the K represents upper-income households expanding their wealth and spending power.
While the bottom line of the K represents middle and lower income households sliding downward, constrained by cumulative inflation and stagnant real wages.
And we see this explicitly in the recent earnings reports. Gap's Old Navy is currently struggling, actually cutting their sales guidance.
Because their lower to middle income shoppers are abandoning discretionary purchases like spring seasonal clothing.
While conversely, Kohl's just posted its best comparable sales numbers in 4 years by aggressively targeting value-conscious shoppers and clearing out stagnant inventory.
But the ultimate stress test of this K-shaped consumer base kicks off this Thursday with the 2026 North American World Cup.
And the economic model for this specific tournament is a masterclass in aggressive, NFL-style stadium economics.
We are entirely past the era of host nations building massive, doomed white elephant stadiums that just sit empty after the final whistle.
Organizers have shifted entirely to renting existing American football infrastructure. The strategy has pivoted from simply trying to fill seats to maximizing the yield of every single ticket through dynamic pricing.
They're deploying algorithmic pricing on an unprecedented global scale. Current projections show ticket and hospitality revenues hitting $7 billion. For context, that is a 7-fold increase from Qatar.
It's massive.
Yeah.
Dynamic pricing treats a seat at a soccer game like a highly volatile commodity on the stock exchange, constantly calculating demand.
So average group games are hovering around $1,000 a ticket, but what really fascinates me is how they handled the secondary market.
Ticket scalping isn't a shadow economy anymore. It is baked directly into the official FIFA platform.
Right, anyone can resell a ticket for whatever the market will bear, and the organizers take a 15% cut from both the buyer and the seller. They completely internalize the scalping premium.
The mechanism of dynamic pricing is designed specifically to hunt for the top line of that K-shaped economy. The algorithm identifies the maximum threshold of price elasticity.
Meaning the absolute highest price a consumer is willing to pay before walking away?
Yes, and the organizers are betting the global appetite among wealthy attendees is so inelastic that they simply do not need the middle class to fill these NFL megastadiums.
And this extends far beyond the stadium gates, right? A New Jersey transit train ticket to the stadium, which is normally about $13, has been dynamically hiked to nearly $100 for match days.
Which is just staggering for a local transit line.
If a transit ticket costs $100 just to get to the parking lot, you might be better off staying home. Honestly, you can always get financial candy, brain candy, and classic audiobooks at claireandhoratio.com instead.
That is certainly a cheaper entertainment option. But the profound risk of this extreme commercialization is that it strips the event of its defining cultural atmosphere.
Because if cultural events simply become walled gardens for the wealthy, the stadiums fill with corporate attendees who rarely bring the noise or the passion that makes the global broadcast a valuable television product.
It's a dangerous optimization curve that could erode the underlying asset over time if they systematically exclude the traditional fan.
Well, if the World Cup is ruthlessly extracting money from the top of the K-shape, we should pivot to a new national policy aimed at building wealth for the bottom.
Yes, launching this coming July 4th, the government is rolling out Trump accounts, which are tax-deferred investment vehicles.
The core feature here is a one-time $1,000 deposit from the Treasury for any child born between 2025 and 2028, invested directly into U.S. stock funds.
The structural objective is to address the massive wealth gap.
Hmm.
Current data shows the top 10% of Americans hold more than 87% of all corporate equities.
By seeding these accounts, the policy attempts to leverage the mathematical power of compounding interest over decades. Even without a single additional contribution, that initial $1,000 could grow to $15,000 by the time the child reaches their late 20s.
But there is a major catch. Currently, only about 40% of eligible children are actually signed up.
And coming from a tech product perspective, there is a foundational law of human behavior. Friction kills the product. Every extra form, every extra click plummets your participation rate.
Right, and the requirement is that parents must manually opt in via a 2025 tax return or a specific government website.
Which is wild.
Mm.
The financial industry proved decades ago that automatic enrollment like auto-enroll 401ks is the only way to guarantee mass participation. Why design a wealth-building tool with this much bureaucratic friction?
The friction originates from political and budgetary compromises. To get a policy like this passed, lawmakers had to contain the estimated cost. By linking enrollment to a tax return, they utilize an existing verification system and avoid building a new administrative apparatus.
But many low-income families do not earn enough to be legally required to file federal income taxes. So the mechanism effectively caps the budget outlays by inadvertently filtering out the exact demographic the policy was designed to help.
Exactly. It seems engineered to ensure the people who need the $1,000 the most are the least likely to navigate the maze to get it.
If you are working 3 jobs, you're not spending your evening hunting down a specific IRS schedule form.
And policy experts are warning this friction creates a highly regressive outcome. Wealthy families, utilizing accountants and financial advisors, are easily navigating the enrollment process.
Plus, the accounts allow for up to $5,000 in annual private contributions, right?
Yes. So at an assumed 10% market return, a wealthy family maxing out those contributions could build a $742,000 nest egg for their child by age 30, completely sheltered from certain taxes.
While the low-income child whose parents didn't file the right paperwork gets nothing. It's a mechanism pitched as a tool to close the wealth gap, but structured in a way that provides a lucrative tax shelter for those who already have means.
And speaking of those who already have means, we should look at how the trillion-dollar club is moving money right now. The rules of capital at the absolute peak of the wealth pyramid operate on a completely different plane of logic.
Seriously, Elon Musk has officially reached a net worth of $1.11 trillion. That's driven by his stakes in Tesla and the highly anticipated public market debut of SpaceX, which is valuing the aerospace company at over $1.8 trillion.
The sheer numbers are staggering, but the truly bizarre part is the incestuous financial plumbing of the AI boom driving these valuations.
Right, so back in 2015, Google invested $900 million into SpaceX, securing roughly a 4.9% stake. Today, that stake is worth over $100 billion.
And just ahead of its IPO, SpaceX announced it is renting $920 million a month of artificial intelligence compute capacity back to Google.
Wait, so Google desperately needs the server capacity to train its next-generation AI models, and SpaceX is monetizing its massive data centers by leasing them to one of its own major shareholders.
Exactly. Google gave SpaceX the seed money, SpaceX built the servers, and now SpaceX is charging Google nearly $1 billion a month to use them.
Pumping up SpaceX's valuation just before they go public, it is a closed-circuit ecosystem. And the hardware side of this AI boom requires even stranger financial engineering.
Chipmaker Broadcom is projecting $56 billion in AI revenue this year, but the silicon required to train these AI models is so astronomically expensive that Broadcom's customers cannot actually afford to buy the chips outright.
So Broadcom is partnering with private equity giants like Blackstone to set up special purpose vehicles, or SPVs, to provide debt financing to their own buyers.
It is a highly sophisticated form of vendor financing. When a company has to facilitate the debt for its own customers just to maintain its revenue projections, it signals a shift from organic growth to engineered growth.
It sounds like going to a car dealership and the dealer inventing a bespoke bank in the back room just to offer you a loan so you can buy their car. But explain the legal box to me. How does this actually protect Broadcom? Why don't they just loan the money themselves?
Well, if Broadcom loaned the money directly to an AI startup and that startup went bankrupt, the default would hit Broadcom's main balance sheet, destroying their profit margins.
And tanking their stock price, obviously. So an SPV is a separate, isolated legal entity. Broadcom sets up the STV, but Blackstone puts up the actual cash.
The SPV loans the money to the customer buys the chips from Broadcom, and Broadcom gets to report pure, risk-free sales revenue to Wall Street.
Oh, I see. If the AI bubble bursts and the customer defaults, the SPV takes the loss, meaning Blackstone, the private equity firm, holds the bag, not Broadcom. It legally walls off the risk.
Exactly. They are inventing bespoke financial architecture just to keep the lights on, and the revenue numbers looking flawless for the quarterly earnings call.
It shows just how capital-intensive the race to build the next generation of AI has truly become.
The infrastructure costs have simply outgrown standard venture capital limits. We are witnessing the outer boundaries of traditional finance stretching to accommodate the sheer scale of the AI hardware build-out.
Looking at all this, today's stories show several distinct economic pressures moving in wildly different directions. On the macro level, we're watching a massive exhale.
Diplomatic frameworks are easing the clogged artery of the Strait of Hormuz, dropping the price of oil, and giving the Federal Reserve the cover it needs to hold rates steady.
But beneath that calming macro surface, the micromechanics of how we price things and build wealth are becoming fiercely complex and exclusive.
We have algorithmic dynamic pricing turning a transit ticket and a soccer match into luxury commodities. We have a government wealth program stalling out on intentional bureaucratic friction.
And we have the titans of tech engineering off-balance sheet debt vehicles just to afford the silicon required to build the future.
Whether it's FIFA optimizing the absolute maximum yield from a stadium seat or Broadcom optimizing the debt capacity of its clients through private equity, the systems are becoming brutally efficient.
But they are extracting capital with surgical precision, and that efficiency inherently creates exclusion for anyone who lacks the wealth or the leverage to navigate the algorithms and the SPVs.
The pressure might be dropping for the global commodity markets, but for the individual, the pressure to keep up is only intensifying.
So if everything from a World Cup ticket to a train ride to an AI-powered data center is now being dynamically priced and financially engineered in real time, will the simple, predictable concept of a fixed price soon become a relic of the past? Something to chew on the next time you tap your card.